First of all, your comment, the last safe haven left, the US dollar, being as weak as it is, the downgrade, of course, in the AAA rating, surely not.
Yes, obviously it's a controversial statement. This year, when investors have been risk averse, they've been buying the Swiss franc and the Japanese yen rather than the US dollar. But as we saw in 2008, when investors become extremely risk averse, and if they're worried about intervention in other currency markets, then they do go back to the greenback. And what we've seen last month in particular, the Swiss National Bank have taken measures to try and stop the franc strengthening. The Bank of Japan has also been intervening to stop the yen strengthening. So that just leaves the dollar. The Federal Reserve hasn't actually tried to intervene to weaken the greenback. That's why we think it is now the last safe haven currency.
You mentioned risk averse. This morning, Indonesian intervening in the rupiah. You've also got the South Korean Central Bank and the Indian Central Bank both selling their dollars. That also clearly risk averse. Is risk averse the real theme of the currency markets right now?
Unfortunately, yes. I think investors are very worried still about what's going on in the Eurozone. They want to know how the Federal Reserve is going to react to the weakness in the US economy. At the same time, there are fears that investors have been very long Asian assets and are beginning now to take profits on those. That's why we're seeing Asian currencies start to weaken. So that's giving investors another sense of unease about the outlook.
Do you think it's right for the Indonesians to therefore intervene at this stage?
I think what we're seeing in Asia is that we're seeing a range of central banks intervening to try and slow the weakness of their currencies, and that's not unusual at all. I think what will be interesting to see, though, is that if this Asian currency weakness persists, whether then we see the central banks stepping up their interventions. I think that's probably likely, but it'll probably not stop the currencies weakening further on a broader dollar move across all major currencies.
You mentioned the next Fed meeting. Of course, that is now 2 days, 20th to 21st. You also mentioned your research that Jürgen Stark's departure, a bit of a shock to the system from the ECB. Again, two of those events really creating a big ripple, aren't they, in the markets?
That's right. Everyone's waiting to see what the FOMC will do at this month's meeting. We don't think that they're going to engage in a third round of quantitative easing just yet. We think they'll undertake a twist of their balance sheet, which should lower long-term yields, but probably doesn't have much impact on currency markets. As for Jürgen Stark, it clearly has increased uncertainty now about the handover between Monsieur Trichet and Mario Draghi, and that happens at the end of October. Investors are worried about the conduct of monetary policy now in the Eurozone.
What for you, therefore, again, with all this European and the US concerns, what is the best trade right now in Asia?
In Asia, yes, sure. I mean, I think investors should definitely be looking at selling Asian currencies and selling the Japanese yen against the US dollar. I think the dollar is going to have a broader base recovery against all major and EM currencies for the time being. I think also investors should look at selling the euro against a range of currencies as well. I think the euro clearly has more downside from here.
Our story as well that William Ackman again is betting that the Hong Kong dollar will actually appreciate against the US dollar and depeg and peg itself to the yuan. Does that make sense to you?
That's not our house view, no. We think that the HKMA have clearly done very well by having the Hong Kong dollar in peg in place since the early 1980s. There's been no signs from the HKMA they want to change this. If you think about it, Hong Kong is a very mature service sector economy. It depends very much on a stable currency. If it were to link to the Chinese yuan, then it would start facing an appreciating currency. That may price Hong Kong out of financial services over the longer term versus other financial centres in Asia like Tokyo or Sydney or Singapore.